Okay, good morning. Time now a few minutes after 9 o'clock in the morning in Tokyo, Friday, June 17th, 2022. Welcome to another edition of online morning seminar. In fact, this is a special edition co-organized by the World Bank and Asian Development Bank Institute. My name is Koichi Mori. I am Senior External Affairs Officer of the World Bank based in Tokyo. Let me switch into Japanese to make a housekeeping announcement on the interpretation. おはようございます。ただいまからセミナーを開催をさせていただきます。本日は同時通訳の音声を提供をしております。インタプリファイのアプリをお使いいただいて、トークンは 0617WBGEP です。どうぞ同時通訳の音声をご活用いただければというふうに思います。よろしくお願いいたします。Okay, twice a year in January and June, the World Bank's Prospect Group publishes a Global Economic Prospect, or called JEP. The latest edition was released on June 7th, 10 days ago. This morning, we have three economists from the World Bank and the Asian Development Bank Institute to discuss the latest edition of JEP report. Please allow me to introduce very briefly our speakers this morning to make sure everybody are online. First, we have Aihan Kose, the Chief Economist and Director of the Prospect Group at the Equitable Growth Finance and Institution Practice Group of the World Bank. Aihan, good evening, good morning. Thanks for joining.
Thank you, Koichi.
Great, thank you very much. We also have Jeonrim Ha, Senior Economist from the Prospect Group of the World Bank. Jeonrim, good evening, good morning to you. Thanks for joining.
Good evening, good morning. Thank you very much.
Thank you very much. Thirdly, we have a pleasure of having John Byrne, Deputy Chair of the Research and Senior Research Fellow from the Asian Development Bank Institute. John, good morning. You're joining from Tokyo. Good morning. Thanks for joining.
Good morning. Thank you very much.
Thank you very much. We'd like to thank Dean Tetsushi Sonobe, John, and the entire ADBI team allowing us to make this event, this joint event happen again. Thank you very much. For the next 40 minutes, we will listen to Aihan and Jeonrim introducing the main findings of the latest JEP report. Then we have John sharing his comment on the report. And then I will ask Aihan and Jeonrim to make immediate reactions to the comment. Then I'll read questions from the viewers asking speakers to respond. If you did not have opportunities to send your question in advance, please send your question using online form posted on the announcement page for the seminar on our website, or simply post your question on the chat section of the YouTube screen. I'll read your question during the Q&A time. Now I would like to ask Aihan and Jeonrim to formally come in to start your presentation. Over to you.
Thank you, Koichi, and good morning to all in Tokyo. It's great to be with you once again. I greatly appreciate the Tokyo office and Koichi putting together this event, and I'm very happy to see John with us, and I'm hoping that I will visit Tokyo sometime soon, and it's wonderful to have Jeonrim Ha with me today to present the latest edition of the Global Economic Prospects. So we will have some slides. Okay, so I think everyone can see the presentation. We released this report last week on Tuesday. The report has usual global outlook and the regional outlooks chapters. But in addition to these two chapters, we have a study on global stagflation and a study on looking at the implications of the war in Ukraine for energy markets and activity. What we would like to do today to focus on three questions to structure our presentation. And throughout this presentation, we are going to use this acronym, EMDEs, Emerging Market and Developing Economies. So the first question we are going to focus on what are near-term prospects for the global economy. And we are expecting much sharper global slowdown than expected, what we expected in January. And we have broad forecast downgrades. There are multiple downside risks that cloud the outlook, and we are going to talk about those risks. The second question, what does this stagflation threat, why does this stagflation threat present challenges for emerging market developing economies? So stagflation is, of course, the combination of high inflation and weak growth. We had a stagflationary period in the world economy, and that was the 1970s. And that stagflation period ended with a series of financial crises in emerging market developing economies. We think that these economies are now facing a rising risk of a similar outcome. The third question, what are the policy priorities for emerging market developing economies? And that starts with coordinating policies to overcome the global challenges, balancing macroeconomic policy trade-offs, responding to food and energy price shocks, and building the foundations for a green, resilient, and inclusive recovery. What we are going to do, I am going to cover the first and third questions, and John Gray will answer the second question. So let me start with the first question. What are near-term prospects for the global economy? When we think about the global backdrop, there are three important observations increasingly telling us global environment becoming challenging for advanced economies as well as emerging market developing economies. The first observation is about commodity prices. Commodity prices increased dramatically since April 2020. March 2020 was the beginning of the pandemic, and during that period, prices actually collapsed, as you see on the left panel. But since then, prices of energy, prices of metals, and of course, agricultural food prices have risen significantly. With the war in Ukraine, price acceleration gained additional momentum. In fact, when we look at the data, since April 2020, the increase in prices over this 23-month period, in the case of energy, it's been the second largest increase we have seen since 1970. The first, of course, the largest increase during this period took place 1973, 1974, when oil prices skyrocketed. Prices of agricultural commodities have risen significantly. When we look at price of food, in fact, the increase is the third largest we have seen since 1970. Prior increases were in, again, mid-70s and over the period 2007-9. The second important observation is about financial conditions. When you look at financial conditions around the world, of course, what happened yesterday with the significant increase in interest rates by the Fed, increases in interest rates by some European countries today, financial conditions have been tightening, along with, of course, the significant declines in equity markets we have seen and spreads widening. In fact, emerging market developing economies are seeing the tightest financial conditions over the past 4 years. The third important observation is about growth of global trade. Last year, in 2021, trade growth rebounded significantly. This year, we were expecting that number to decline from around 10.5% to around 6%. But now we downgraded our trade growth forecast for this year around 4%. We also downgraded our forecast for next year a little bit. In a nutshell, we have this external environment. You look at commodity markets, you look at financial conditions, you look at the growth of global trade, increasingly difficult, especially for commodity importing economies, especially those economies with elevated debt levels, and economies they rely on, of course, trade as an engine of growth. Against this background, we are expecting the sharpest slowdown in the global economy following a global recession over the past 80 years. We are expecting growth this year in the world economy to decline to 2.9%, half of what we saw last year. In the case of advanced economies, we are expecting a sharp decline from 5.1% last year, 2.6% this year, and emerging market developing economies as well. We pretty much halved the growth number from 6.6% to 3.4%. We downgraded our forecast for the world economy, advanced economies, for emerging market developing economies for this year and the next year. So when you look at the regions, you also see significant forecast downgrades. And all regions are going to pretty much see weaker growth relative to last year, except Middle East, North Africa region. And there, of course, the countries they export oil will see higher growth this year, and that makes a big difference. In East Asia Pacific, we downgrade our forecast by 0.7 percentage point. This is mainly driven by our forecast downgrade in the case of China from around 5.1% to 4.3%. And that was mainly driven by COVID-related interruptions in the Chinese economy. We expect growth to be around 4.4% next year, this year. And then, of course, next year is going to be 5.2%. And that number is much lower than what the East Asia Pacific region delivered over the period 2013-2019. In the case of Europe, Central Asia, because of the war in Ukraine, we are expecting for the region as a whole a significant contraction. Ukraine will contract significantly, or more than 40%, and Russia will contract more than 8%. If you take out Russia and Ukraine, there is growth in the region, but we pretty much downgraded growth forecast for almost all countries in the Europe, Central Asia region. Latin America, Caribbean, South Asia will see lower growth this year relative to last year, and we downgrade our forecast. In the case of Sub-Saharan Africa, growth forecasts were not downgraded, but still the region will see a significant slowdown and weak growth. When you put all of these things together, there are common sources of this sharp slowdown. One of them, of course, Russia's invasion of Ukraine disrupted the global economy, already struggling to put together a recovery. Commodity prices increased, inflation levels went up, and we saw fiscal and monetary policies were being withdrawn. This is taking place while demand is moderating around the world. So economies are slowing, and policy measures are basically adding to that slowdown. And there are significant supply shocks translating into weaker supply as well as affecting prices. This figure shows you how forecasts have changed for different groups of countries. The reds tell you fraction of countries forecast downgraded this year. For the world economy as a whole, we downgraded growth forecasts for this year by more than 70% of countries. Advanced economies, we downgraded by more than 80%. Commodity importers, we downgraded around 80% of those countries' growth forecasts. In the case of energy exporters, growth forecasts were downgraded just about 25% for obvious reasons. But for other commodity exporters outside of energy, forecast downgrades were widespread. So this is telling us we are going through an extraordinary slowdown, and that slowdown is broad-based with significant consequences for the global economy. This slowdown is taking place while multiple risks, they amplify each other and they translate into the possibility of even weaker growth. The first risk is, of course, geopolitical tensions. And those tensions are associated with the war in Ukraine and the possibility of that war spreading or intensifying. In the baseline, we think that the war is going to concentrate in northern Ukraine. Another important risk threatening the global economy is the risk of stagflation. We are expecting several years of elevated inflation and weak growth. Energy and food insecurity have become major risks for many countries. In fact, food insecurity has risen to new levels because of disruptions driven by the war in Ukraine. Ukraine and Russia are important suppliers of staple food commodities, and the fact that Ukraine is unable to export its grain and other types of commodities, translating into much higher prices and affecting some countries since they rely exclusively on Ukraine for their imports of certain food items. Social tensions, a significant threat when you have high inflation, weak growth, food insecurity, high, of course, gas prices. Always there's the possibility of social tensions intensifying on the streets. We have COVID-related outbreaks continuing, and we saw the implications of that in the case of China. And with COVID disruptions, as well as war-related disruptions, added already present supply interruptions. And those interruptions could intensify and add to inflationary pressures. Because of the threat of inflation, we see central banks around the world increasing interest rates, like the US Fed did yesterday, and today multiple European countries did. A number of countries have elevated debt levels. That brings the risk of financial stress. In an environment, growth is slowing and the cost of borrowing is increasing. Some countries might suffer from payment difficulties. I have not talked about climate-related challenges, and I have not talked about the possibility of fragmentation of trade, investment, and financial networks against this background. And beyond that, there are, of course, challenges associated with weaker long-term growth prospects. We undertook some scenarios looking at the implications of these risks and what will happen if these risks materialize. We focused on three major risks. The first one, much faster than expected tightening of financial conditions and financial stress. The second one, deeper energy supply disruptions and higher, of course, energy prices. And the third one, additional COVID-19 outbreaks in a major economy, emerging market economy like China. When you put together these disruptions, global growth this year easily go down to 2%, and next year could go down to 1.5%. So this year's growth forecast around 2.8% in the baseline. So we might end up seeing growth much lower than that. And next year, our growth forecast is around 3.1%. And we might end up seeing a growth number, if these risks materialize, half of that. So near-term prospects are extremely challenging. And one of the important risks that basically overshadowing near-term prospects is this risk of stagflation, a period of high inflation and weak growth. I'm going to turn to my colleague, John Graham Ha, who produced this study on global stagflation in the latest report. And he will focus on the second question. John Graham?
Sorry, let me. All right, thank you very much, Ayhan. So let me start with the second question. So returning back to our list of the risks, which Ayhan just all listed, in the the one that has become more pronounced, more prominent now is the risk of stagflation, which I have.
John Graham, your for some reason, I see the screen is doing funny things.
Is it still? Is it still working that way?
It's working now. Yeah, please continue.
Okay. Thank you very much. So in the following slides, I would like to discuss the recent inflation and output growth developments and some similarities and differences between 70s and now, and finally main challenges for EMDs and main lessons from the 70s. So let me start with the recent developments in inflation and output growth. So actually, we had expected inflation to subside early this year, but that was before the additional commodity price shocks hit after Russia's invasion of Ukraine, and before the lockdowns in China caused yet new supply disruptions. So generally, those supply shocks that we had expected to unwind have been much more persistent than expected, and so has high inflation. So as you see on the left, inflation is running at a 14-year high in both globally and in EMDs. And in the case of advanced economies, inflation is running a 4-decade high this moment. And of course, inflation expectations for this year and next year have also increased, in particular since the war in Ukraine. So we are beginning to look much closer to the stagflation of the 70s than we did 6 months ago. And in fact, by some measures, we are in stagflation. And the term stagflation is poorly defined, but the general consensus is that it's the state of high inflation and weak growth. So if you define high inflation as inflation above targets or at multi-year highs, and if you define weak growth as steeply, slowly growing growth, then 2020 may qualify. And there is a risk that the next few years will also qualify. So now inflation is, as of this month, running above target ranges in all advanced economies and in almost most of the EMDs. And as you see on the left, based on our simulation with some time series models, then we still expect that global inflation to peak around the mid of this year and then gradually decline to around 3% around the middle of the next year. And as you see on the right, more than half of that decline is because of easing energy prices. And you can see the orange bars disappear in the right chart. But that still leaves global inflation 1 percentage point above average in 2019 or pre-pandemic levels. And when it comes to the growth, then even if you look through the current steep cyclical downturn, then long-term growth prospects don't look good either. So in the prospect group, we estimate potential growth based on long-term fundamental trends such as labor markets, productivity, and investment. And these all point down and have long done so. So the chart on the left suggests that global potential growth over the 2020s will be around 0.6 percentage point lower than over the 2010s. And this is increasingly being recognized by consensus forecasts, as you see on the right. So they have steadily downgraded their long-term 10-year ahead growth forecasts. And for the world, for example, the long-term forecast global growth is now 0.7% less than what it used to be 10 years ago. And when it comes to the EMDs, then 1.8 percentage point lower. Then how can you compare the 70s and now? What are the main similarities and differences? So of course, the steep growth slowdown coupled with high inflation has echoes of 70s stagflation. And so does the 5-fold increase in the oil prices and near doubling of food prices. In fact, left chart shows how the rebound in energy and food prices from the pandemic low compared with the past commodity price spikes. So in the 70s, these big energy and food prices spikes triggered the global recession of 75. And the post-recession rebound was also followed by a steep and broad-based growth slowdown, as you see on the right with blue bars. But today's rebound from the global recession of 2020, as you see on the right again, or red bars, is much steeper. And also similar to the 70s is the long period of monetary policy accommodation that preceded the war in Ukraine, and the one that preceded Volcker's Fed chairmanship starting in 1979. So when Olivier Blanchard first raised the red flags about the possibility of stagflation earlier this year, he referred to the negative real interest rates in the United States, like you see in the left. Even if you broaden your horizon to the beyond the United States, the prolonged period of negative global real interest rates is an obvious comparison. And in both 70s and 2010s, that contributed to a large run-up in EMD's debt, as you see on the right. So for example, EMD government debt is now at the highest level since 1987, and private debt is at its highest level on record. But again, history does not repeat itself. It only rhymes, to just paraphrase Mark Twain. And let's move on to the differences. So there are some important differences from the 70s. So arguably, the most important difference may be the transformation of monetary policy. So in the 70s, advanced economy central banks had just exited the Bretton Woods system. EMD central banks were all still in pegged exchange rate regimes. At that time, the notion that might be responsible for inflation had not quite gained that attraction. If anything, they operated along the Phillips curve, trading off inflation with unemployment. But since then, there has been a complete U-turn. Now, all the major central banks prioritize price stability. All of them have dramatically improved their transparency, their independence, and their inflation fighting credentials. And that has paid off when it comes to the anchoring inflation expectations. So as you see on the right, medium-term inflation expectations are now much less sensitive to inflation surprises than they were even in the early 2000s. And hopefully, they can now capitalize on those decades of building credibility. So now financial markets certainly expect them to be able to quell inflation with a smaller interest rate increase than was necessary in the past. And another difference is that we are still early in the high inflation period, and outside the United States, price pressures are still mostly in non-core items. Globally, headline inflation is still only half of what it was in the late 70s, and core inflation is not even 1/5. And outside the United States, wage pressures are also still much lower than in the 70s. Then what are the main messages, key messages from the 70s? So left chart, you see all the cumulative policy rate increases through the past tightening cycles since Volcker was the Fed chairman. And as you see how high core inflation was at the beginning of each cycle. And this current one stands out. But for this level of core inflation, markets are expecting a very muted tightening cycle. If it materialized, however, it will be a testament to the Fed's 3 decades of building credibility. And in 79 to 80, it took a near doubling of US interest rates to 19% to bring inflation back down. And that was in the context of highly synchronized global policy tightening. So global policy rates were also doubled to around 14% between 75 and 81, as you see on the spikes in the right chart. So that interest rate increase was followed by steep 20% US dollar appreciation in the first 3 years of Volcker's Fed chairmanship between 79 and 82. And this policy tightening did bring down inflation, but it triggered the global recession of 82, in which global per capita GDP fell more than 1% and half of the world's countries were in recession, as you see in the middle. So, and advanced economies remember the Volcker recession of 82 as the end of stagflation. But EMDs remember it as the beginning of a string of financial crises, as you see on the right. Then what could be the policy implications? So let me turn to Ayhan for the last question. Thank you very much.
Thank you, Jongrim. Let me conclude quickly with policy implications. So policy implications we think in 2 domains. First, global policy priorities, and that starts with basically finding ways to reducing the short-term pressures, and of course, building long-term foundations. In the short term, there is significant damage from the war, and that needs to be contained. That includes supporting refugees and their host governments and countries affected by the war, of course, and preparing for rapid reconstruction after the war in Ukraine. But also further away from the war, the global community needs to help countries to cope with the damage from the war. Especially low-income countries and fragile countries need help in alleviating food insecurity after the global food price surge. And this is where the global community can play an important role. And of course, based on our work, there is a crisis. That crisis presents opportunities. And here there's an opportunity to support this green, resilient, and inclusive recovery. In many countries, global community has made significant progress when it comes to vaccination. But in low-income countries, vaccination rates are still low. So it's going to be critical to accelerating vaccine rollout and strengthening pandemic preparedness. That levels quite high, especially low-income countries. Some middle-income countries are struggling. And whenever there is a possibility, providing that relief rapidly is going to be critical. Energy price surge provides an incentive to accelerate the energy transition away from fossil fuels. Beyond these, of course, the public good, the rules-based international economic order needs to be maintained and bolstered to guard against the risk of fragmentation of trade, investment, and financial networks. At the national level, managing short-term policy trade-offs and building long-term foundations are critical. There we focus on macroeconomic policies and structural policies. On the macro policy side, monetary policy needs to give priority to price stability and adjusting the policy to avoid derailing the recovery and stabilizing the inflation expectations. Fiscal policy needs to ensure fiscal sustainability, but at the same time, making sure that investment and social spending is protected. This is only possible in a medium-term fiscal plan. And the financial policies should focus on enhancing financial sector resilience. On the structural side, there is this largest refugee crisis since the Second World War taking place in Europe. Integrating refugees and migrant workers, expanding public services are critical policy priorities. Beyond that, of course, there are structural interventions in the context of education, health, female labor force participation and productivity, and business clients. And these are still critical in an environment we see weaker long-term growth prospects. And when it comes to energy and food-related challenges, implementing targeted support rather than distortionary policies like subsidies or export bans or price controls going to be critical to basically respond intelligently to high food and energy prices. Let me summarize. The first question we asked today was, what are near-term prospects for the global economy? We are expecting a much sharper global slowdown than what we predicted in January 2022, and we downgraded our forecast for around 70% of countries around the world. The menu of risks is much larger, and the challenges are much larger now confronting the global economy. The second question, why does the stagflation threat present challenges for emerging developing economies? As John Graham explained, the 1970s stagflation period was a truly traumatic episode for the global economy. There was a recession in 1975, and there was another recession in 1982, and both of them were worldwide global recessions. And both of them were related to this stagflation episode. And there is a possibility, again, we will have serious challenges, especially in the context of emerging developing economies, because of elevated debt levels and rapidly increasing borrowing costs. Third, what are the policy priorities for emerging developing economies? Of course, this is high time for policymakers to be agile, to be basically very clear in their communication, and thinking through policies that are not going to have counterproductive impacts. I articulated those policies. If you are interested in these issues, we have extensive menu of publications on commodity issues, on the impact of war for the global economy, and we are in the process of producing some other publications, and I look forward to having the conversation today and beyond. Let me stop here. Back to you, Koichi. Thank you.
Thank you very much, Ayhan and Jong-Lim, for your keynote presentation. I really appreciate it. Now I would like to ask John Byrne from the ADBI coming in to share his comment. John, please come in.
Thank you very much. Will you share my slide? Okay. So it's a pleasure to have the opportunity to present my views on the latest report. I also had the pleasure to present my views on the report in January, and clearly the global economy environment has changed substantially since then, and the outlook that was presented back then is substantially different, of course, for the reasons that we all are very aware of. So I congratulate Ayhan and his team for producing such an excellent and comprehensive assessment of the global economy situation. And so basically my comments will be largely complementary, but I hope to provide some further insights which may inform the subsequent report in January 2023. So next slide, please. So let me summarize the three challenges that were highlighted in this edition of the report. So of course, stagflation is the main concern at the moment, whereby at the global level we face stagnant growth and rising inflation for the reasons that we're all very aware of: global supply chain disruptions, which have impeded trade, and commodity price rises as a result of that, which are affecting the global outlook for growth across all regions of the world. On top of that, we have amplified economic and financial uncertainty, which is contributing to this stagflation for the remainder of the year, and concerns in that regard on the real side. Second point is about external public debt in developing economies, and this is a concern at the moment given tightening US monetary policy and the extent to which there are financial stability risks associated with an appreciation of the dollar and risks of default for some emerging market economies, which may be exposed on that basis. On the third point, which is also linked to the other points as well, monetary policy tightening in the US is a significant concern, certainly as regards its impact on capital flow developments and exchange rate movements, which are all amplified by heightened volatility in financial markets and commodity prices at the moment. So these are the three challenges that were highlighted in the report. There's significant analysis on each of these issues, particularly the first issue, and particularly actually on inflation. And I want to discuss some of those points in the next slide. So next slide, please. So as Ayhan concluded in his last section of his presentation, there are a number of policy areas which derive from the analysis. The first one is on global policy coordination to address the humanitarian crisis due to the situation in the Ukraine. So clearly avoiding fragmentation and polarization is of key importance. Second point is about policies to counter the developments that we've seen in food and energy prices. So essentially around initiatives to boost supply would be important there. And some of the analysis in the report goes into more detail on that, and that's very useful for policymakers, I think. Thirdly, as was also highlighted in the previous report, debt relief is a key issue. This is well known. These are the longer term sort of issues that are faced not only due to the current situation, but perhaps have been amplified due to the current situation. This is also highlighted in the report as an important policy issue. Health preparedness, also a key concern with vaccination coverage low in some low-income countries, which should be addressed. And finally, the transition to a low-carbon energy economy is highlighted in the report as well, which is obviously something which has been in place for some time. So can I go to the next slide, please? I have 5 main comments on the report, and these are as follows. So firstly, on global policy coordination, I think Ayan actually explained this much more clearly in his presentation compared to my reading of the actual report. So it's important to distinguish between the short and the longer term challenges. And the shorter term challenges are of course, those related to current developments in energy and food, for example, fiscal policy challenges, which have become more amplified in the current environment. Fiscal policy was already constrained coming out of the pandemic, and now we face further fiscal policy constraints in the current period. Global interest rate development is obviously something which is short, potentially a longer term concern as well. Something that's not really touched on is the issue of negative externalities associated with sanctions in Russia, particularly obviously by the EU. I think the report highlights that Europe is the only region that will face a recession during 2022, and that's partly related to the negative externalities associated with the sanctions that are imposed on Russia for that. And there's a question of whether there may be spillovers from the situation in Europe abroad, in Asia, in other parts of the world as well, which may impact upon the growth outlook there. It could be something to look at, certainly to monitor in the next few months. Then, of course, on the longer term challenges that we face, these were outlined in the presentation very clearly, notably the accelerated transition to a low carbon economy and tackling inequalities. But I think it would be useful to explain a little bit better the short and the longer term in the actual report. The second point, as was discussed very extensively, is the issue of global inflation and inflation expectations. There are some cross-country and regional differences in the level of inflation that has been affected by external price developments. But I think for the role of monetary policy, it's really important to understand the second round effects and pass-through of price effects to wages, and also understanding the impact on inflation expectations, because of course monetary policy will have a longer term horizon. So obviously there's a lot of uncertainty at the moment, so it's difficult to ascertain the inflation expectations impact, but I think it would be very useful if more could be pulled out on that side. And this will also link to whether the effects that we see are having some permanent effects, which would not even subside in the event of an easing of the situation in the Ukraine. So this would be something to delve into a little bit further. Supply side shocks, spillovers to the real economy, that's essentially what we're talking about, and the role of monetary policy in affecting the real side. And really to assess that involves a deeper analysis of inflation expectations. Coordination of monetary and fiscal policy is obviously very important, and perhaps that could be something to look at in more detail, notably, as interest rates are increased, this would require some targeted fiscal policy easing for certain vulnerable sectors and certain sectors of the economy, for example, to balance it out. Third point is on foreign currency denominated EME debt. I mentioned that at the start, but I think, yes, this is clearly a concern as the US tightens monetary policy. The appreciation of the dollar can leave some vulnerabilities in this regard, where US dollar denominated debt is elevated. But what are the policy options there? What can they do about that? I know that many emerging markets, for example, face insufficient hedging capabilities, and that would be something to look into further. Not only the level of financial development, but the extent to which they can really actually hedge their currency exposure. And it's something that we have been talking about for many years, of course. But I think there's still a need to address that issue. Next slide, please. I just have two more main comments. So the next comment is on. I found that, first of all, this special focus on stagflation and the comparison with the 1970s, extremely interesting. But my question is, what can we really draw from that in terms of lessons ahead? There are clear differences now. There are clear similarities as well. I mean, if we look at the similarities, we had a supply shock. We had a accommodative monetary policy in the period before the shock. We had vulnerability of emerging markets to tightening US policy after the shock. But on the other hand, I think the changed environment for monetary policy at a structural level, it's such that it's very difficult to pull out lessons from the previous period compared to what we see now. Central bank credibility is clearly much stronger now. Central bank communication to markets is much more prevalent. We have forward guidance, for example. And I think that the anchoring of inflation expectations is much more improved competence of central banks, not only in advanced economies, but particularly in emerging markets. And this makes it difficult to really pull lessons out of the previous period, where none of those structural frameworks on monetary policy, if you like to call it that, were in place. But I mean, I found the chapter extremely interesting in terms of looking at the different periods of stagflation that we had, and actually the one in the 70s ultimately led to a global recession in 75. So we would hope to avoid that this time around. And the last point I have relates to the other special chapter, which was on energy. And I think it would be useful to again draw out some policies that we can really delve into to look at that issue. And one important issue is how to leverage private investment in renewable energy, because this is clearly a key issue given fiscal constraints, and involving the private sector is something that will really make energy transition come to fruition. The chart here is from some recent work I've done with co-authors to show how governments may actually leverage private sector investment through different types of policies on renewable energy, whether it be government expenditure on R&D as a leverage vehicle at the early stage of renewable energy adoption, through to feed-in tariffs, which can be important in this regard as well as tax incentives. So these factors can be very important, and I just put this here to highlight the fact that we should be looking at policies that we can really implement and advise governments going forward to boost private sector investment in renewable energy. Clearly, the environment at the moment is such that investment by the private sector in any sector is less attractive given the risks involved. But I think if we look at this as a longer term objective, it should be something to consider and research further going forward. So, but that's all my comments on the report of June 22. I think, again, it was an excellent assessment of the situation. I particularly like the scenarios that were developed going ahead, and whether we will face actual global risk, a global recession going forward, and the factors that would contribute to that. And yeah, again, thank you very much for the opportunity to comment on the report, and I look forward to your comments on my comments. So thank you very much.
Thank you very much, John, for your comment, including 5 points that you raised. So let me ask Ayhan and Jongmin to come in to make immediate responses to John's comment. Ayhan, please.
Thank you, Koichi. It's wonderful to have John providing feedback to us. I think all of his points are very relevant. John talked about the global policy coordination and the need to think about the short term and long term. What do these mean? Definitely, there are short term challenges global community needs to look at, and I basically see his points in the context of energy and food security concerns. And the issues he raised, the kind of the fiscal policy challenges, especially confronting low-income countries, critical. And beyond that, over the longer term, the accelerating energy transition. Having said that, I wouldn't call accelerating energy transitions a long-term challenge. It's a challenge today, and it has to actually take place as quick as possible, and the investments need to be adjusted to have that transition. And the tackling inequalities, of course, is a challenge. Hopefully, as we are seeing the global economy slowing, the policymakers will respond in a way that we will not end up seeing even larger inequalities around the world. I'm going to ask John Grimm to focus on these questions with respect to inflation and stagflation. One point John mentioned whether the 70s provide a good reference point, given that we see central banks implementing the different and much better policy frameworks. This issue is very well taken. And obviously, that's one point we make in the chapter. Having said that, I think we need to realize, despite all that credibility, we have record high inflation in many countries, the type of inflation we have not seen in decades. Credibility is there, but obviously policy response has been so far not compatible to contain inflationary pressures. Credibility is something difficult to gain, but easy to lose. So that's why 1970s comparison is critical, because it talks about the delayed policy response. And when the policy response is delayed, whether the central bank is credible or not, the response has to be much larger. And I think what we are seeing increasingly a much larger response than policymakers considered 3 weeks ago, 4 weeks ago. But John Grimm will get into the details with respect to inflation expectations. With respect to foreign currency denominated emerging market external debt, obviously, this is something at the bank we monitor very closely. The debt levels are historically high, as John Grimm showed in his slide. And external debt levels also elevated. In an environment, you see a sharp tightening of financial conditions, increasing US interest rate. We have a rather strong US dollar, which is actually quite different than what we had in the 70s. This presents a significant challenge for emerging market economies. They have their own domestic inflation problem, And they also need to worry about how they are going to basically handle even much more appreciated dollar. So in a nutshell, policy options in this environment are quite limited. That require these policymakers first to be credible, second, very competent when they communicate, and of course, the third, design policies that will convince markets these policies will have, well-defined results. So in the context of monetary policy, we are already seeing central banks in emerging market developing economies tightening policy, putting a lot of emphasis on price stability, and they are also trying to withdraw fiscal policies to make sure fiscal sustainability concerns are addressed. And at this point, that's the kind of I think, best mix they can have. Of course, this has consequences for economic growth, but they need to live with those consequences rather than basically losing the control of inflationary expectations and, of course, the stable currency. With respect to energy transition, I completely agree with John that we need to find ways to leverage private investment for renewable energy. In that chapter, we looked at what happened in previous energy basically price increases. One of the things that happened is that new sources of energy basically brought to the markets. But these new sources of energy, most of the time, were oil, basically, discoveries, or try to use the basically agricultural products, the land, to produce biofuels. Now, in this environment with increased food insecurity concerns, we think that allocating a larger amount of land for biofuel production is not the intelligent policy to implement. And of course, we are not recommending to basically to think new sources of hydrocarbon and the further delaying the response to climate challenge. But when we think about these new sources of energy, this is a great period to focus on renewable sources of energy and accelerate the energy transition and reduce of course, the overall reliance to polluting sources of energy. Let me stop there, and John Graham is going to focus on inflation, stagflation related issues. John Graham?
Thank you very much, Ayhan. Also, thank you so much, John, for the great summary and great comments. So, yeah, on top of what Ayhan explained in detail, let me briefly touch upon a couple of questions, comments about inflation and stagflation. So, I fully agree with the point on the importance of the second round effects and the transitory and permanent effects. So, indeed, so when we were writing the pieces in the Global Economic Prospect report, we care a lot about the first and second round effects from the oil and food price markets into the general broad-based inflation. So I mean, of course, I mean, compared with the 70s and now, we do not see that much severe sectoral dispersions, the spillovers from the energy and food markets into the other markets, including core inflation. But having said that, we are getting some more evidence about the possibility of the second round effects of the supply shocks. For example, the correlation between energy and food prices and core inflation has been increased over the recent years since the pandemic. And also, as you just pointed out, there are despite some differences in the inflation levels across EMDE regions and countries, but in particular after the war in Ukraine, then we see some broad-based increase in inflation across the EMDE regions. So so all in all, so I think the second round effect from the supply shocks and energy prices should be really carefully considered in quantifying and in getting the messages about the implications on inflation. So indeed, in our chapter, we kind of implemented employed several time series models to quantify the implications of the oil price shocks. And so one of the models suggests that around the 50% increase in oil prices will maybe associated with around 4 to 5 percentage point increase in global inflation within 2 years. But other models broadly get the consistent results. But again, that's based on our assumptions on the inflation expectations and the less severe second round effects. So this is again very important issue. So I also fully agree with your point on U.S. monetary policy spillovers to emerging and developing economies. Of course, I mean, whether there is the policy changes in the United States, then there are large consequences and spillovers into financial markets in those open economies, in asset prices and foreign exchange rates, and of course capital outflows. So to be prepared for those spillovers, we've actually witnessed that many of the emerging markets have started to tighten monetary policies to enhance the correlation between the monetary policies in US and other advanced economies with those economies. So last year, according to our sample, around 40% of the EMDs started to increase policy rates, and this year another 25% of those have joined the group of the policy tightening. But we'll see how long the tightening cycle of those EMDs will last and how much they have to increase more policy rates to overcome those side effects. And finally, about the point about the main messages from the 70s about the stagflation. And it's a great point again. And as I briefly mentioned about during my presentation, it took several years and virtually the doubling of the interest rates to in the case of the United States to bring down inflation. And if we just look at some comparison across countries, then even in the 70s, we have some policy lessons and which we documented in detail in the chapter. For example, in the case of United States, Italy, UK, or France and Spain, that they all observed large inflation and they had to come up with large changes in interest rates. But at the same time, when it comes to Germany and Japan or Austria and Switzerland, they also observed some high inflation in mid 1970s. But they kind of started, the policy tightening somewhat faster than compared with other advanced economies, and they end up having much lower inflation rates, earlier than those advanced economies. So again, if we look at the financial market data, where we compare the core or headline CPI inflation with 70s, then still markets are pricing in or markets are expecting much lower interest rate hikes to rein in inflation at this moment. But again, as you mentioned, it really depends on the anchoring and the anchoring of inflation expectations. And if we just witness, record high inflation rates all the way again, then those market expectations will be also de-anchored. Let me stop there. Thank you very much.
Yes, thank you very much for your replies. Excellent points. I think still, of course, we face challenges ahead on the extent to which interest rates should rise, because of course we don't want to trigger a global recession. And this is something that we learned in the 70s, that in 1975 a global recession was triggered. So that's why it's very important to look at the inflation expectations and not to overextend on the monetary policy tightening. But yeah, challenging times ahead, certainly. Thank you very much for your comments.
Thank you, Ayhan and Jong-in, to your responses to John. John, thank you very much for your comment once again. We received several questions from the audience in advance and also during the presentation. So let me read several questions and then ask the Ayhan and Jong-in to come in. And if relevant, I will also ask John to come in to make a comment. First one, the question that we received from Sasaki-san in advance to the seminar. Thank you for your question. How do you see the status of remittances and its future prospect and impact on the global economy in the current challenging situation? So this was a question from Sasaki-san. And then we received several questions from the same anonymous participant, but let me read one of them. With regards to inflation, I would like to know how you would analyze the influence of volatility and fluctuation to the market by dishonest speculators. This was the question. And then we have actually Kitaoka-san from Nomura online, and then he has his question submitted in advance to a seminar, but since he's online, so please, Kitaoka-san, come in to raise your question.
Thank you, Mori-san. I'm Kitaoka from Nomura. Yes, today's presentation is so great, and market participants are so keen on the risk of stagflation. I have a quick question on the much longer term issue, that is population, but potentially related to stagflation, suggested by Charles Goodhart, his book, Great Population Reversal, which has been recently translated in Japan. The point is the depressed birth rate after COVID-19. This is so severe in Japan last year, 1.3, but I think much more so broad-based in worldwide, and so somehow different between the high-income and low-income companies. My question is, what is the potential impact of such a depressed birth rate or population dynamics on the long-term growth prospect of global and developing economy? Thank you.
Thank you very much, Kitaoka-san. Ayhan and Jong-in, please come in to respond to those questions. Thank you.
Why don't I turn to John Grimm about the demographics and inflation question? And thank you for raising this issue. We discussed in the JEP chapter, we also have a separate piece looking at these issues in detail, and John Grimm led that work program. John Grimm?
Sure, thank you very much. And thank you very much, Kitaoka-san, for a great question. So indeed, I mean, when it comes to inflation, then there are some cyclical factors and also long-term factors that explain, inflation or disinflation. So for the interest of time, today we did not include those factors on the long-term forces, including demographic forces. But in the chapter of the JEP report, we explain detail about each of the some of the long-term forces about disinflation, and of course, one of the most important part is demographics. So, I mean, as you might have read or listened to the debate about from the Goodhart and Pradhan, over the recent few decades, the demographic factor has been one of the key factors that have explained the disinflation across the globe. And there are growing voices, that the factor is waning out, and this may turn up the inflation in the long term. So I mean, for example, the population aging, or the lower birth rate, as you mentioned, or so-called great retirement. So for many reasons, the working market participants are declining, and also some because of the supply disruption issues. There are some changes in the trade and financial market openness, and then there is the critical decline in economic labor forces, and this is assumed to have very positive and impact on global inflation. So yeah, let me stop here.
Thank you, Dongrim-san. Thank you for your comprehensive explanation.
There were a couple of other questions I think, Koichi, you raised. One of them is about remittances. Am I correct?
Yes.
So in the context of remittances, we have a report produced by our colleagues at the World Bank. We released that report in the first half of May this year. So our expectation in that report, the remittances are going to grow to low and middle income countries, remittance flows by 4.2%. And that's going to basically take these remittances around $630 billion. And last year, in 2021, that number was around 8.6%. So we are seeing a moderation, but it is still quite significant, around 4.2%. We are expecting a sharp increase in remittances to Ukraine, around 20% this year, but many Central Asian countries depend on Russia, are likely to see a decline in remittances. So in other regions, for example, in East Asia Pacific, we are expecting a moderation in the growth of remittances in 2022, around 3.8%. In Latin America, the number is going to be actually around 9%, Middle East, North Africa, around 6%, South Asia, around 4.5%, and Sub-Saharan Africa, around 7%. So the important thing to remember here, remittances provide a mechanism to stabilize consumption and, of course, investment as well in emerging developing economies during slowdowns, during downturns. We have done quite a bit of research on these issues, looking at the role of remittances in providing better moderation of basically consumption fluctuations. The other question was about the role of speculators influencing the volatility. This is an issue especially relevant when you see, of course, the market is not deep enough, and the volume of transactions, in some cases small, the speculators can have a larger impact or can have an impact on smaller segments of certain financial markets. And there are certain risks, and those risks need to be monitored by regulatory and supervisory agencies. But let me stop there. Koichi, back to you. Thank you.
Thank you very much. Thank you. John, you have any additional comment on those points discussed just now? You are unmuted.
Oh, sorry. Yes, I think there was one point about inflation volatility raised, and I think this is certainly an issue that policymakers need to be aware of. But of key importance, I think, is not only the volatility, but also the level, and the level over the longer horizon. And this is something that we discussed during the presentation on the issue of permanent effects and looking at inflation expectations. And this is something that, while uncertain, we need to make efforts to look at that issue very closely, because this will underpin monetary policy decisions. So yes, inflation volatility is important, but I think even more important is the level over the horizon.
Thank you very much. We received 2 questions directed to Ayhan during the presentation. So let me read those 2 questions asking Ayhan to respond. First one, Question from Tom O'Sullivan. Thank you for your question. Ihan spoke about delayed policy responses in 1970s. How would you characterize the policy responses so far for this crisis in 2022? That was Tom's question. And then the another question from Pradeep Panti from the ADBI. Thank you for your question. Question to Ihan. In recent years, many emerging economies are facing challenges to manage volatile capital flows and exchange rate fluctuations. The pandemic, current situation of Ukraine, subsequent rise in global prices of food and oils, and increased exchange rate have created a lot of pressure to those economies to strengthen macro-prudential regulations concerning domestic financial sector, building foreign exchange reserves, and increasing debt transparency, etc. At this time, U.S. federal rate has been increased. How can emerging economy may consider their macro-prudential regulation with respect to these changes? So these are the two questions from our viewers to Ihan. Ihan, if you have any responses to those points, please.
Thank you, Koichi. About Tom's question, you know, hindsight is 2020. It is easy to say the policy response has been delayed in the context of what central banks have done over the past 6 to 8 months. But when I think about the evolution of inflation over the past 12 months, last year, this time, there was consensus that inflation was going to moderate as supply disruptions, the supply disruptions slow, and demand basically moderates as well. And policy measures, especially through fiscal policy measures, are being withdrawn. The commodity prices unfortunately remain elevated, actually increased, and then because of the war in Ukraine and the COVID outbreaks in China, we ended up having even larger inflationary pressures. I think the central banks erred, in a sense, on the side of waiting for inflation to go down naturally, as these forces to play a smaller role. That did not happen. And now the issue is that whether they can get ahead of the curve and provide a robust response to contain inflationary pressures. We saw that yesterday, what the US Fed did, delivering a 75 basis points, the largest increase since 1994 in interest rates at one meeting, and signaling that they will continue being very determined to contain these inflationary pressures. We received similar messages from ECB, from Bank of England, and other major advanced economy central banks with significant inflationary pressures. And we are also seeing many emerging developing economies withdrawing policy support, tightening monetary policies to get ahead of inflation. So I think that the response has been slow so far. Whether it has been delayed enough to have many years of persistent elevated inflation as we had in the 70s, I think that has to be seen. So I think my response is a little bit nuanced. I am still thinking that given the credibility of these central banks, given their ability to basically react and stabilize inflation expectations, the short-term expectations, if we don't see more supply disruptions that could translate into even higher inflation, and labor market pressures moderate, this inflationary period can be behind us, hopefully in 2024 or 25. About the second question from Pradeep, this is very important for emerging market developing economies, how to think about macroprudential policy while they are facing these challenges. The policies were relaxed during the pandemic, so those policies now need to be adjusted given the kind of the menu of risks we discussed, and in a sense the monitoring function of the regulatory and supervisory agencies has become very critical, and of course tightening these macroprudential policies in a way that they have a good sense of the credit flow, they have a good sense of the vulnerabilities in the financial sector, and they have a good sense of how they can, conduct necessary stress tests to see the resilience of financial institutions. Beyond that, we are basically recommending these countries to really strengthen the measures when it comes to corporate bankruptcies and try to have those procedures improved in a way that if there is a wave of corporate bankruptcies, they can intervene basically quickly. So having said all of these, these are easier said than done, but there is a lot to be done given the type of global outlook we have been painting since we released this report. Back to you, Koichi.
Thank you very much, Ayhan, for your responses. Before concluding the seminar, let me ask your final words, perhaps in order of John, Jong-Lim, and Ayhan. Then we wrap up the seminar. John, any final words from you?
I think my final words would be, again, congratulations on the report, and I look forward to the subsequent report in January 2023, where I hope to have the opportunity to also be involved in this seminar again. So thank you very much, Ayhan, and all your team as well. Thank you very much.
Thank you very much. Jong-Lim, please.
Hey, thank you so much for this great opportunity and great time and great comments. So if I may, then I can just add just one each point for each question on top of what I had mentioned in detail. So when it comes to the Tom's question, I think in the 70s, the misunderstanding about the Phillips curve was the one issue about the policy errors. They thought the kind of Phillips curve is a trade-off unemployment and inflation, but it's kind of fixed. But now the questions are totally different. I think, as John and Ayhan said, it's a matter of shock magnitude, size, and persistence of the shocks. And on the question about the Pradeep, then I totally agree that, but I would like to add that the policy design should be really tailored to country-specific circumstances. So in last year, most of the EMDs that tightened monetary policies were, inflation targeters, of course, but oil importers and, those with flexible exchange rates. So maybe the terms of stress shocks or other macroeconomic shocks will have different consequences on oil exporters or low-income countries in the context of the food prices. So this is all what I can add. And again, thank you very much for this great time.
Thank you very much, Jong-Lim. Ayhan, please come in to share your final words.
Thank you, Koichi, and let me thank John again, and thanks to you and our colleagues in Tokyo office for organizing the event. It's always a pleasure to have this event. We have been doing it online. We used to do it actually in person prior to the pandemic, and I'm hoping that we will get back to those days and we will see each other in person. I think the important point here, global economy is going through an extremely difficult period. there's a narrow path for policymakers to intervene and basically adjust their policies, get ahead of inflationary pressures, get ahead of the kind of the type of food and energy insecurity related challenges. This will require finesse when it comes to policy making. This will require credibility. This will require clear communication, and this will require intelligently designed policies. My hope is that in advanced economies, as well as in emerging market developing economies, we see the implementation of those types of policies. I think challenges are clear, problems are clear, and in most cases, I think we have solutions, as much as those solutions are not necessarily easy to implement. But if there is time to implement these solutions, it is the time, given the type of slowdown we are experiencing. So let's hope that these forecasts are going to turn out much better than what we are expecting here. And hopefully we will be in a better position at the end of this year. Once again, thank you, Koichi, and thank you, John. And I'm very happy that we were able to spend time with you with John Grip. But let me stop here. Thank you.
Thank you very much. We had a pleasure of having Ayhan Kosei and John Lim Ha from World Bank and John Byrne from Asian Development Bank Institute this morning. Thank you very much for your time to join us. Really appreciate it. Thank you. Great. Next week, we are going to have a special seminar to introduce a very interesting project, Vietnam Northern Mountain Integrated Child Nutrition Improvement Project. This was funded by the World Bank Japan Social Development Fund, JSDF, and the project was implemented by the Save the Children Vietnam. This seminar will start at 4 p.m. on Friday, June 25th. This seminar will be held virtually using WebEx, and you will need to register in advance to obtain the link. So we'll make sure to send the link to you once you register the seminar. With that, once again, thank you very much for watching the seminar. Stay safe, stay healthy. See you next week. Thank you.
Thank you. Bye-bye.